Ladies and gentlemen, here we are as the alternative voice. Welcome to the most awaited and the most anticipated discussion that we will be having tonight. And just to bring you up to speed, nimeenda mbio sana. We would like to know how you're doing wherever you're joining us live from. This is the alternative voice, and I'm your host as usual, Cleophas Oloch. And remember to subscribe if you are new here, and if you are a returning subscriber, click on the subscribe button and on that bell, notification bell. This is the alternative voice, and welcome. Tonight we're talking about, if you can say, financial literacy with more inclination towards taxation. Yes, here we are to learn some one and two things about taxation, and that's why we are here with our guest tonight, Mr. Erick Odera. Who is our guest tonight? Our guest tonight is here, and as you can see, and from the audience, Bilha Joy is already tuned in as always. Thank you very much, Bilha. And here we have our guest tonight, Mr. Erick Odera. Mr. Erick Odera is a certified public accountant, if you can call it CPA Erick Odera. Yes, thank you very much, Kodera. As many people would really wish to call you, those on the backstage, as Gabriel Odhiambo anasema, Kodera is here. And so we are talking about our topic tonight, and that's understanding taxation, new taxation laws in our country. Feel free to join us in this discussion. Karibu sana, Mr. Odera.
Thank you very much, Cleophas. Hello, how are you guys?
I'm good. Welcome to this alternative voice tonight.
Thank you. I'm glad, and I welcome our viewers and everybody else to this exciting topic. It's my humble pleasure to present and take our viewers and everybody else who is excited about the tax regime to the Finance Act 2021. I'm hopeful that our viewers and everybody else tuned in will find this the session very interactive, very educative, and I'm looking forward to interacting and engaging fruitfully with everybody, so that we all contribute positively to this development. Thank you.
Great. Nice to have you here, Mr. Erick Odera. And if you're joining us, kindly tell us where you're watching this live show from. Gabriel Odhiambo watching from Kabuoch, Alex Onsase watching from Nairobi. Bill Hajoy, are you still watching from Narok? Share with us where you are watching us from. Best up, Prof. Karibu sana. And everyone who is joining us live, our topic of discussion tonight, Alex Onsase, Karibu sana, Mr. Odera. Anasema hivyo. And so we want to have this candid discussion tonight about taxes in this tax regime. We really want to know how we surviving in this tax regime, and with the implementation of the Finance Act 2021, and it's already in use, how are we surviving? And that's why Mr. Erick Odera is here tonight to talk to us more about this interesting topic. We are 7 minutes past 8 p.m. That's East Africa time, and we go straight into the discussion. Mr. Odera, karibu, and tell us about this amazing topic that we have today, that's the Finance Act 2021 and understanding the taxation generally. Yes.
Okay, thank you very much, Cleophas. Straight to the point. Let me start that. Let me state from the onset that the Finance Act 2021 was assented to on 29th June 2021, and it brought a range of changes to different tax heads. We'll look at each one of them. The tax heads that are affected include Income Tax Act, the Value Added Tax or VAT, Excise Duty Act, the Tax Procedures Act 2015, now some changes there in 2021, the Miscellaneous Fees and Levies Act 2016, the Capital Market Act, the Stamp Duty, the Retirement Benefit, and the Insurance Act. I will start from a very hot topic, which is being exploited by young entrepreneurs, and which is offering a lot of opportunities for most of our youngsters, and that is the digital service tax. The digital service tax is a tax aimed at taxing the revenues generated from digital platforms. We will define what a digital platform so that our viewers know what is this digital
Digital
platform
marketplace.
and the digital marketplace. Well,
Yes.
a digital marketplace generally refers to a platform where a buyer and the person offering the service interacts with the person receiving the service, or the person selling the good interacts with the person receiving the good. That definition is important. One of the changes was to include what is called online business into that definition, because you find that some people are doing business or are carrying out the business of buying and selling over the internet or digitally, but then they could claim that theirs is not an online business. So the definition of the online business was included to mean or to fall under the digital service tax. Now the tax is charged at 1.5% of the gross value, and it is taxed once a month. So if you trade from 1st of January to 31st of January, then the gross of that the turnover is taxed at 1.5, and you are expected to remit that to the Revenue Authority by 20th of the preceding month. On the digital platform, another change which has come into effect is the fact that the residents, when you say a person is resident for tax purposes, then it means that you either have a permanent home in Kenya, or you have been in Kenya for at least 183 days or 6 months, or you have been in Kenya for at least 122 days and any other day in the last 2 or 3 years. Presumably, most of our viewers are resident for tax in Kenya, and therefore we call them residents.
Resident.
Resident. Resident. The term resident means a different thing from the term citizenship. We will not go into the definitions, but resident for tax now.
Yes.
So being a resident for tax means that your income, the income that you accrue or derive, is taxable in Kenya. Now, the people who are residents for tax in Kenya are not liable for the digital service tax. This is the main reason for this is that your income is already being accounted for, annually, if you are in business, or you're paying pay as you earn if you are employed. So then you don't again need to pay again the digital service tax, because it will be like you're being taxed twice. Okay. Yes. But if you are employed, if you are having the digital business, and your main source of income is the income that you are having, as you are accruing from the internet or from the digital platform, you're supposed to accrue it. You're supposed to account for it, once a year and pay tax on it. And the beauty of it is that if you register a business and you're trading under a business name, a limited, that is, then you're able to claim all your costs, all the costs that you incurred during the operation. You can claim all that, and then you are able to pay the tax which is due.
Mr. Erick, if I can take you back to
Yes.
Digital service tax, which you've said if you are not a resident of this country, and of course you're not exempted to this tax, and they're supposed to pay it on 20th of the preceding month. If that's the case, is there a penalty for such cases? Because what we know and what we've come to realize as a country, or those who are tuned to this channel, there are those people running their businesses from outside the country. They are Kenyan citizens, but they are having their businesses in the country and running them abroad. How can you advise them if at all they pass the deadline of
Okay.
20? Are there penalties?
Sure. Well, there's a penalty for non-filing and non-paying of tax. I've said that for non-residents, if you are a non-resident and you are having, you are operating in a digital market, you're able to generate your revenues in the digital platform, then you are supposed to file that return. That means declaring your total revenues and paying 1.5% by 20th of the next month. For instance, those of you who traded in the month of June, from June 1st to June 30th, now before 20th of this month, you're supposed to declare that your revenue and pay 1.5%, failure to which attracts penalty. The penalty for non-filing is normally 5% of what is of the tax due, and 10,000 for non-filing. So you incur a late penalty fee of 10,000 plus, which you don't need to if you can file your return before the due date. Okay. There is one advantage which the non-residents are given. The non-residents, if you are operating on the digital marketplace, you are and you are also having maybe other consultancy services you are offering, then that consultancy service will attract withholding tax. Now, the part which attracts the withholding tax is exempted from the digital service tax. So that's a relief for you, and you can exploit on it. You can be having your businesses on the digital platform, but then again, you can offer consultancy and do other things, and that will not be taxed. Okay?
Yes.
I will go to the second change which came about. This touched on registered trusts. Now, the income of registered trusts, which is normally paid by a trustee on behalf of beneficiaries, if you are incurring an expense, you are the beneficiary, and your recurring expenses such as educational costs, medical, and housing, and that expense falls below 10 million annually, that is in a year, then that part will be exempted from tax. So you will find that you're able to pay your fees, you're able to meet your medical costs, and you're able to pay, for instance, your rental costs and all that. And if it falls below 10 million, then it is exempted. So that is one change, which is on the taxation of trustees. Now, there is another important bit of it for family trustee. If a family comes together and register a trustee, then the transfer of all the properties under that family trustee can be transferred among the family members, and the transfer doesn't attract any tax. So that is another welcoming move, which the government is doing. I think what the government is doing in this case is to try and encourage as many families as possible to form family trust. That is not just for to spur economic growth among the family members, but also to help in settling squabbles and disputes which might be arising when it comes to distribution of family properties. Okay.
Yes.
Any question up to that extent?
Mr. Erick, if we can get from the audience, there are those people who are seriously concerned about those who are having dual citizenship. And here is one question from Shiro Kim. For dual citizens having businesses affiliated in both countries, in that the businesses are interlinked? Are they exempted from any tax?
Well, for associated businesses, that is related, not associated, but related businesses, you find that maybe you have a company in Kenya, which also has another company or a similar company, or let's say a parent in Kenya and a subsidiary in another country. Or let's say you have a parent in the US and you have a subsidiary in Kenya. A subsidiary company in Kenya is taken as a local company in Kenya. So you're supposed to accrue you're supposed to do your books and determine how much incomes you got in the year, subjected to the expenses, and then you pay the taxes that are due. Every country has its own tax rules. The question you are asking touches on international taxation. You may not really be exempted in different jurisdiction. The main reason is that income is subjected to tax depending on where you are generating it. Okay, so that if you register a company in Kenya and you are generating that income in Kenya, then part of that income will be taxed in Kenya. But in cases, or there are other cases of whereby you find that you can have a way in which part of the income that you are generating, or all of it, goes to the parent office, then it comes back. There should be a formula of which you should be using, so that no country is disadvantaged in terms of taxation. And you should not be, you should not be capitalizing on anything, because then it will border on a serious thing, which I don't think we'll be able to discuss, but it touches on something called transfer pricing, which we cannot deal with for now. Okay.
Then, thank you very much for giving an appropriate answer for that question by Shiro Kim. And Mr. Erick will be here with us for the next, if I can say, 40 minutes. And if you're joining us, Mr. Erick is here, and this is a certified public accountant, if you can call that CPA, and he has experience in various fields, and if you can say, on taxation, auditing, accounting, business advisory, and consultancy. Feel free to share with us your concerns about taxation in our country. Where is that? Where are you getting the pinch at most? Where is it pressing the most? You can join us in the live discussion through the comment section, and we'll be here to shed more light on the topic tonight. So we continue, and Shiro Kim is saying, thank you so much, Mr. Odera. More questions to come, and that's the way to go tonight. So, Mr. Odera, you highlighted some of the areas that were affected by the implementation of the Finance Act 2021. You've just done the part for the digital service tax, and we are in a position to see how much the penalties if you don't meet them, and how you are exempted from them. Now, moving to the next form of taxation that has been affected in this kind of implementation. Should we go to the income tax, where
yes,
they are not seriously earning? Yes.
Yeah, still tackling the income tax. Well, earlier in the year, when the year started, there was something on minimum tax. Well, the court has stopped its implementation, but minimum tax, just touching on it briefly, was that it was supposed to be taxed on the gross turnover. It had a lot of weaknesses, which we raised at the institute as accountants and as professionals. We raised this and we contested it seriously, because one of the weaknesses was that it was not considering practicalities of business, such as issues of receivables. It had no considerate on your losses. It had no considerate on the fact that you could be having bad debts and such kind of things. So we contested it. It is not applicable until the court determines it. So we leave it at that. for now. However, moving forward, there was the other changes which came with the income with the Finance Act 2021. There's one on carrying forward of tax losses. So businesses are allowed, and I mean trading businesses, not just a trading name, but a business trading, a limited, a partnership, and such kind. They are allowed to carry forward their tax losses indefinitely, meaning that if you incurred a tax loss last year was a difficult year, this year is so equally difficult. So if you incur tax losses in these years, then you are allowed to continuously utilize that tax loss in the subsequent years, even if you make a profit, and it helps you to come up to rejuvenate, so that you're able to move on. So it is a welcome move. There's another change on interest earned before tax, depreciation, and amortization. Initially, this was capped at 30% for most businesses. However, there's been an exemption on banks and small and medium-term enterprises offering loans. Why is this important? It is important because the chunk of the income from for banks and these credit advancing facilities is the loan. So so if you find them if you find that the interest was capped at 30%, that it would minimize them. But now with this kind of arrangement, they are allowed, they're completely exempted. So it's a welcome move for the banks and for these credit institutions like I think the Kenya Women and such kind, which try to spur economic growth through giving of loans.
So, to interject you, if it's welcomed by these institutions, if you say the banks and these small and medium-term enterprises that are really concerned with the loaning aspect, on the other side of the receiving end, we can say there are those people who are going there to seek for those loans. How are they covered with the comfortability of the loan provider or the person who is offering this loan? How are they covered? Are they going through the same how hard is it for us who are going for the loans?
If you are going for loan, you can claim the interest expense on loan, okay, as an expense. The interest on loan you can claim as an expense, so that you are not taxed on the fact that you're paid your interest back. So that's the relief for you as the person who has taken the loan from the bank. Okay, but the bank is.
How is it possible to claim this expense? Because most of these people in the small and medium-term enterprises, they don't have this tax information. They're only starting these businesses, and they just want to go straight, get that loan, and once they pay, tuseme home to kuuza mtumba, after kuchukua mtumba, then they are there with that facility and they are offering such kind of service. Then at the end of the day, they return the money with the interest on. How should they know when to apply for these expenses, and who should they go to?
Sure. Okay. I think that's a very good question, Cleophas. I sometimes feel very bad. I find that small and medium-term enterprises, in as far as they're financing their loans, they're really incurring a huge interest expense to pay back their loans. But you find that when they're coming to do their accounts at the end of the year, that part of the interest is not captured, which I don't think should be the case, because you have paid that money. It is like an expense, just like rent, just like transport, and you're allowed to claim it. So include it as part of your interest, your expenses. And that's why we are here as consultants. That's why we are here as your auditors and as your accountants, so that we sit down with you at the end of the year. We look at, this was your loan, and this is the principal amount you paid, but on top of it, you are charged interest. This interest is an expense, so you should not pay tax on it. you should claim it as an expense so that it reduces your tax liability. Okay. So we'll be leaving our contacts and how you can access us and how we can be able to get you going forward. Okay.
Great, great. And we'll be sharing those contacts in a few with our audience tonight. And there's Don Apple Jaka tuned in from Kochi, India, our producer there. Can I claim my CRBN listing as expenses due to loans from digital money lending institutions?
Well, if you are paying this CRBN listing, okay, and you are paying it from income that you have earned from the business, and maybe if you took this loan to do business or to expand the business, it is claimable. It is an expense. Claim it.
Great, great. And there are those people asking about tax filing returns, be it nil or at the end of the term, the financial year. Yes, those are the questions that will be coming through. And feel free, share your concerns, share all those doubts that you have when it comes to taxation. And the expert is here tonight to shed more light on this. Thanks so much, Don Apple Jaka. We have Zansha Zenith, tuned from Kisumu. Thank you very much. Media Initiative Community. Is this Arapo Kebe? Unpack the 20% excess duty, watching from Gwasi. And I know the excess duty is another act that you'll be tackling immediately you're done with the income tax. And we are on the right track. And thanks so much for everyone who is joining us tonight. Our guest is Mr. Erick Odera, who is a certified public accountant and who is also a consultant when it comes to matters auditing, accounting, business consultancy. Feel free to share with us your worries about taxation, your businesses, and where you are expected to go. Dan, watching from Kayole, VP Kodera, thank you for representing tonight. Duncan Mwathi, karibu sana, and the other Dan, Asante. JK, watching and learning, thank you very much. Beneta Esau Diambo, thank you, Cleophas, for hosting Mr. Kodera to expound on Finance Act 2021. And we have so many people are tuned in. Thank you so much. Tell us where you're watching from. Wellington, watching from Garissa. Asante sana. And so, Mr. Kodera, we catch you when you are expounding more on the Finance Act 2021. What else do we need to know when it comes to income tax?
I think there's another important bit of it, and this now concerns employers. You'll find that small businesses and even maybe corporates and all that who have engaged one or two personnel who are helping them, and they're deducting part of their they're deducting salaries and remitting as pay as you earn. And sometimes you find that they take even students from the university and maybe even from vocational and these training institutions. Now, the Finance Act 2021 allows them to, to claim 50% tax rebate on the cost that they incur, both on students from the university and this vocational training. And this is a welcome relief. Initially, you find that employers were only allowed to claim that tax rebate on graduates. It now covers even students from vocational training. So the students themselves are allowed to can be paid, and then the employer, because the responsibility to deduct pay as you earn and remit to KRA is on the employer can now deduct. Now, the student, when you receive your income, normally individuals are taxed at graduated rate. You should be able to know how much you're given, and so that you declare it. And you should be declaring your return not more than 6 months after the closing of your accounting period. You can find that normally accounting period for most individuals, actually most individuals, the accounting period should end on 31st December. But you might find outlier, you find some cases where individuals finding themselves with the accounting period ending January, February, and so forth and so on. It doesn't matter. What matters is after the end of your accounting period, 6 months afterwards, you should be declaring your returns to Kenya Revenue Authority. And if you have a payable, you make payments. If you have a credit, if you're a company, you have a credit, you can carry it forward and utilize it. In some cases, there are credits even on individuals, and some people have been asking me, do I claim this money back from KRA? I don't know. It has never happened. However, if you have cases of late filing and you are charged penalties, or if you're trading and you're charged penalties due to one or two problems, it is your right. You can apply for a waiver on interest and penalties, stating the exact reasons as to why you are not able to remit, you are not able to file your return. Maybe you are sick, or you had exams, or you traveled somewhere and it surpassed you. You are engaged in some conference which took your time and all that, and you're able to prove that. You can file for waiver of interest and penalties. We can always assist you where you have problems, and we'll be able to sort those kind of problems.
And so, Mr. Erick, when you talk about the filing returns, I think now it's timely to bring the question by Bila Joy. Thanks. We can get that question on our screen. Thanks to the Alternative Voice for bringing enlightening guests. I have a question on filing returns. Is that ideal? Fit for towards this conversation? It's fine. We can now tackle this question. And anyone who has the problems to do with the filing returns, be it nil or the other ones, feel free. We are here, and we'll have the contact details of Mr. Erick displayed down there as he's typing to the production team. He'll be in a position to display those contacts. But now we'd like to hear from him. When it comes to filing returns, we've seen those questions. Mtu ana file nil returns late or failing to file completely, and there are penalties to this. How should they approach such a situation when some of them are students, of course, most of them are students, and some are just at home or doing other kind of work? Yes, how should they approach the issue to do with filing?
Okay, thank you very much. Well, on filing of returns, number one is that returns supposed just to give a summary of your incomes and expenses, and tell the revenue, the commissioner of revenues, whether you earned or you didn't earn. Because once you have registered for a PIN, personal identification number. Once you have registered for a KRA personal identification number or a PIN, then you are obligated to declare your returns. Okay. Now, if you happen not to have any income in the year that is to be reported, let's say 2020, okay, and you are in 2021, and your year ended on 31st December. Now you are supposed to remit your returns by 30th of June, 6 months after. Now, if you happen not to have had any income in the year 2020, then you just do a nil return. And doing a nil return is simple. You just log into your iTax and you file nil return. Okay, it's a very simple one, but we can assist you where you have a problem. But now, let's say you have incomes. Let's say
for these people who are filing nil returns, Mr. Erick, some of them fail. Are there penalties, and how can they go about these penalties? Okay. Because those people tried applying for waiver to no success.
Fine. Well, let me answer you first, then I go to the other bit. Yes, there are penalties for unfiling. For individuals, if you fail to file your return, you will be charged a penalty of 2,000 shillings. Okay? Every year. I think the act was changed in 2017, 16. I'm not sure. Initially it was
20,000.
Yes, it was 20,000. Okay?
Yeah. It was changed in 2019. Yes.
I think 2017. So now it is 2,000, which is a welcome relief. Okay? But that is for individuals, and it's especially for students who are in colleges, because when you are in the college, you might not know that you are expected to file your return. Initially, people used to rush to take KRA PIN just for purposes of applying for educational loan. Yes, not knowing that there is an obligation to file your return because you have a PIN. But now, the good part of it is that yes, you have you didn't file your return by 20th by 30th of June. You can file a late return and you'll pay a penalty of 2,000. Now, if you don't pay or you don't have the money, you can apply for a waiver. Again, application for waiver is simple. It is done online. You have to do a justification as to what happened that made you not to remit your return in time. And that justification, you'll upload it in that iTax, and it will generate for you an acknowledgement which shows you that your application has been received. It is not a guarantee that when your application is received, it will be worked on, but it is your right to apply. It is the commissioner's right to work on your application, either affirming that, yes, he agrees that you did not file for one or two reasons and therefore you are exempted, or he might decline and therefore you're subjected to that kind of tax. So you can do that application by yourself or we can assist you. Now, let me come to company. For instance, let's say you are running a business and you have done you have had your trading all throughout the period from January to December. What you should do is you should be able to have very good records showing all the income that you generated in the year 2020. And I'm using the year 2020 as our base year, just for illustration. So you should be able to tell the commissioner that these are my incomes for the year 2020, and these are the income, these are the expenses I incurred. The expenses could be electricity, transport, telephone, internet, water, all that. Those expenses should be the ones that you exclusively incurred to generate the income that you are declaring. I'm using the word exclusively incurred because that is the term used in the Income Tax Act. So get it very clearly so that you do not just have to claim any other expense. Let's say the income that is not related to that, expense that is not related to the income, then that can be disallowed. Okay? Yeah, but you are allowed to claim as much expense as you can, so long as it was incurred exclusively to generate that particular income. Okay.
And in all that you disclose and in all that you declare, you must have that evidence or proof that that transaction or that expense was really incurred.
Yes, you have to have your records, and you should be keeping those records for at least 5 years. For at least 5 years, because KRA can audit you for at least 5 years. Like now we are in 2021, KRA can audit, and the audit can go back up to 2016. So if it happens, then you should be able to produce those records to show that on this basis, I declared such an income. On this basis, I claimed this expense. Okay. Now, some cases, when you, if you have a business, then maybe case you find that KRA can assess you. There's something called an assessment. An assessment is where KRA goes through your records and says that you owe them this amount. You can object. Okay, you can object within 30 days. Again, you don't have to do it yourself if you're not an expert on it. You can engage us, and then we do it on your behalf, and we carry it forward on your behalf, and we justify the reason as to why you did declare like you did.
Mr. Erick, to whom is this assessment directed to? Can they come to anybody, or you must have committed some offense for you to be subjected to such an assessment, or is it done to any other person in our society?
Well, KRA can pick on any taxpayer, and especially if you have if your declarations are questionable, if you are not able to, if you claim extraneous expenses, your expenses are just overboard. So that, in other words, you claim them in such a way that they declared materially your tax payable. then in that case, you can be subjected to audit, you know. So not that everybody can be picked. KRA can sample, but again, they can pick on anybody depending on your declarations. And that is why I'm insisting that if you're not so sure about your taxes, then you engage an expert to guide you so that whatever you declare can pass. KRA is getting very strict. There are a lot of changes, a lot of scrutiny. So I think we should go with what Chinua Achebe taught us, that if the eagle learns to fly, if the hunter learns to shoot without missing, then the eagle should learn to fly without perching. Okay.
What a way to bring this show almost to 40 minutes since we went live. And we have this question from JL Empire. Why are low-income earners in Kenya being taxed comparatively more than high-income earners? Is it true from that statement, Mr. Erick?
Well, it is not true because, for instance, if you are individuals are taxed at the lower brackets. From 0 to 24,000, for instance, that is the first rate, which is at 10%. And you find that the relief for that is 24,000. So you'll find that if you are earning below 24,000, then you go scot-free. You are not taxed. Now, if you earn more than 24,000 to around 28,000, you are taxed at 25%. And above that, then you are taxed at 30%. So that is for individuals. But maybe, and even for companies, they're taxed at a flat rate of 30%. And again, it is just dependent on your income. The more you generate, in terms of your taxable amount, then the more it attract tax. Okay, but well, payment of tax. I want to deconstruct this narrative that if you try to pay more tax, then it is punitive in any way. No, it is not. I think we should encourage more and more people to work hard, because if you work hard, you generate more. Then you give our government some money, and then everybody else, be able to move.
Wow, tax issues inatumaliza jamani. That's the expression from Best Star Prof. Tuna maswali sana, and so send in your questions. Let us know your concerns about this taxation that we are currently discussing. And so, Mr. Erick, if it's all about income tax, if there is anything you'd like to add before we move to excess duty, where so many people are concerned with also VAT. Just to finish, then you brush through VAT and excess duty. There are questions from, we got one from Wellington, and we have one from Media Initiative Community, Unpack the 20% excess duty, watching from Gwasi. If you can get you moving through that.
I think I have only one last bit to add on income tax and move on to the next. There is another relief, or another important aspect which was brought in by this Act of 2021, and it touches on something we call the capital allowance. Now, capital allowance are to make it simpler, is the depreciation that you normally claim on your property, plant, and property, plant, PPE. So normally you'll find that initially it was charged. You would charge it at reducing balance. That is, you charge at 30% now. Then next year you charge 30% of what was left from this year. Now this year, the new change says that you charge it at a straight line, which is very important. The reason is that you can charge up to zero, so that it enables you to claim your capital allowance fully. Okay. The other thing is that it also allows you to enjoy that deduction, like on the first year. You enjoy it until for instance, if you purchased a laptop to use in the business, and the laptop has a useful life of 5 years, then you just divide the value of the laptop, divide by 5, and you claim a constant amount as a capital allowance all throughout the year until the laptop's value falls to 0. That's very important because it helps you to reduce your taxes. So that was one other change which was very, very important. I think we move to VAT or exercise, and then we'll
Yeah,
be able to press
we
those
move to
questions.
VAT and excise.
Okay. Now, one of the first change in VAT was that the commissioner tried to widen the scope of VAT to include digital service tax. And I think this is a welcome move in the sense that the digital um, service tax was, you'd find that people who are trading digitally are incurring input of VAT. Maybe they are offering services that they have to purchase bundles, and in those bundles they are charged VAT. You'll find that in some the internet provider charges them VAT, and they would not benefit from that input. So now the finance bill the Finance Act has widened, has included the VAT on the digital service tax, which is a very good initiative, so that then you can claim your input. For me, that is welcoming, because it helps so these small businesses to survive from the large corporations that provide those other services, which they are also using. The second important aspect was the fact that there was a group VAT. So it is now possible for a group of companies, each one of them, to register, for VAT. That is important in the sense that if you do your trading, you can claim individual input without necessarily having to be confined to the group input, which is another very important one. There's another important aspect of it in hiring and leasing of taxis, and these passenger cars. Now, the VAT tax, the input VAT on those hired vehicles and leased vehicles have been restricted. Okay, so it is restricted because you yourself, when you are going to charge you're going to charge your passenger, do you also charge VAT? Because you see, VAT is supposed to be an interplay between the input and output. So if you are only benefiting and you are not charging it, then you might end up claiming it without giving the government anything. So that is the main reason as to why it has been limited. I'm just looking at something else to add on change in VAT. The other one was on the change of status of goods from standard to exempt. You realize that the Finance Act has changed certain goods like milk and sugar from standard rate to exempt, basically to reduce cost, to reduce the price, and enable consumers to be able to purchase these goods. But one other important one was on medical goods, which were totally exempted from VAT. Main reason is that you'll find that the medical institutions, the health facilities, and all that, they themselves are not supposed to be charging VAT. So it was exempted to help them reduce those costs. Now, we need to add here that medical services do not attract VAT. And
there's this question from David Oluoch. I think it's just related to the medical part that you're just handling. And this is David Oluoch. The question is, can medical expenses relating to the directors of a company allowed for tax purpose? Maybe you'll just go through that after finishing your explanation.
Yeah, I was explaining that if you are a doctor and you're offering medical services in town, maybe as a private practitioner, okay, you don't pay VAT. Your service does not pay VAT. unless you are selling medical equipment. Again, even in the medical equipment, what the Finance Act has exempted them. So the medical goods, all of them have been exempted. So the main reason is to help and make the health costs affordable for most people. There's the question coming to this question: can medical expenses relating to directors of a company be allowed for tax purposes? Well, this medical expense is a benefit to the director, and this director is not generating this income. I mean, this medical expense does not relate to the income that the company is generating, so that this medical expense pass. I think that this medical expense, KRA will have an issue with it, because what can be allowed is something like NHIF, because NHIF becomes part of the salaries that you're paying. But if it is just a medical expense, then it becomes a benefit to the director. So the director then will be expected to declare it as part of his income, so that then he is taxed on it on the graduated scale, and then he can claim a relief on it. Okay, so you should be very careful with it if you are declaring it.
And so before we move to excise duty, there are those who are asking how can you file nil returns, and that has been explained. You just log in to the iTax portal and you'll be in a position to file it, or you can
repeat it.
Yes,
I can repeat it. Yes. It's a simple one. Just log into your iTax, go to file returns. Okay, then you take file nil return. Then you will be asked whether you are sure you want to file nil return. Then you just say you are sure by saying yes. Then you shall have filed your nil return, and you will generate an acknowledgement to that effect. Okay, but make sure that your whatever you are doing is correct. Because if you have things like withholding tax, because you are offered some service somewhere, then the system will not allow you to file a nil return. And the nil return should not be a return. Some cases, some people file nil return because they are not ready or the audit is not completed. Okay, so you should file nil return, but then again, if that is the case, you should do your returns in time and then be able to file the correct return. So you'll be amending.
We have the concern here from Alex Onsase. I have a business. Every time I'm filing tax, Adi Nadhani naibiwa, please help. There must be an error with the new bill. Sevas.
Okay, fine. If you have a business, that's beautiful, and I hope you have registered that business, and that business has a PIN, and has a certificate of registration, which means it becomes a person in the eyes of the law. So let's say it is Cleophas Limited, or it is Erick Limited. Okay, that business then is the one that I am hopeful you are talking about. This business, you can claim expenses on it, because I'm sure you are housed somewhere, so you are paying rent, and I'm sure maybe you are having deliveries and transporting your goods to the store and such kind. You claim that. So and make sure that you keep your records, so that every time you incur an expense, you have an invoice to that effect. You have your records very straight, and you have them kept somewhere. Then you can bring in an accountant also to help you look at the kind of income you are declaring and the kind of expenses you are declaring. And you will find that you are whatever you are declaring, when you go through it with your accountant, then you are able to certify yourself that the government is not taking much from you, and you are also not retaining much which the government should take. Okay, I hope, Alex, you've got us.
Yes, and we have that's from Alex Onsase. Thank you very much, Alex Onsase. If you're joining us now, That's the contact for Erick Odera, and you can get them at the Allingham office, Silverpool office. So it's along Jabavu Lane, and you'll be in a position to repeat that in the course of this broadcast tonight. And so, if you're joining us, we are talking about understanding the new taxation laws in our country, and that's in Kenya. There are those people watching us from outside the country, and we have one called I just lost him. Can we get him? Cephas Nyongo is tuned. Thank you very much, Cephas Nyongo. And Cephas Nyongo has a question here for you. For some who have done international tax system, CCA, is it mandatory to do the KRA course for them to consider your employability?
Well, I think if you have, I don't understand what you mean by employability here. But anyway, if you have done an international tax system through a CCA, which have certified you, I think if you want to practice in Kenya, then you should apply to ISPAC, that is the Institute of Certified Public Accountants, which they can certify you and give you a practicing certificate. Or if you want to basically do, deal with the taxes, then you can also get a tax agent certificate from KRA. You can register with the KESRA, and then they will take you through the stages, and you'll be able to be certified. I think that thank you very much. I've seen Mr. Washington. Thanks. I think that one thing I've noted is that SCCA and ISPAC, they normally collaborate together, and you are able to be guided on what exactly you need to do to practice in Kenya. So SCCA is well much recognized. ISPAC will not have any problem with you in that regard.
Great. Beda Graphics. We have tax credit and the tax deductions. How do they differ?
A tax credit is a situation whereby instead of having to pay, in your tax return, where you have a tax, when you compute in your tax computation, once you are done with everything, you either end up with a positive figure telling you tax payable or tax due. Then if it is positive, then that is a tax to pay. But if it is negative, it is a tax credit. And a tax credit or some arises where you have an overpayment, for instance. Maybe if you had withholdings which have exceeded your tax payable, then you will have a tax credit. Okay. And a tax credit, if it is resulting from overpayment, by the way, our taxpayers should know, is that you can claim them. Like if you have a VAT tax credit, then the VAT tax credit and your records are good, we can follow it up. Thanks, Jackie. And then you are able to follow it up with the KRA, and you can be refunded. So tax deduction, on the other hand, a tax deduction. I mean here, I think you mean here a tax, an expense deductible. An expense deductible is an expense exclusively incurred in the production of an income. For instance, you are operating, maybe doing some business, and you have rented a house. That your rented apartment, you're paying rent. That rent is tax deductible. In other words, you can claim it from the income that you are supposed to pay. I think that is what the questioner meant there.
Yes, and you've tackled it pretty well. And I know we are geared towards now the excise duty, and on the same, we want to deal with the imports and exports in this country, and at the same time, spurring that success to the local manufacturer and that local farmer in the country. How is it impacting? Is it a positive thing to have the tax done heavily? All those who are from outside, the importation thing charged highly to help solve the problem? Or how was it done? Why is it done?
Okay, thank you. I think there have been a lot of outcries. There's been a lot of concerns people have been raising on the issue of excess duty. First, let me say that there was a proposal to charge fees on or to amend the definition of fees so that it was charged on excise duty. Now, fees or commission, and the major change was on the definition of the term other fees. Other fees. Other fees mean something in terms of your incomes and in terms of the Income Tax Act. Because other fees means you are earning this principal income, then you're also charging other fees. So if you are, for instance, offering some other you are a debt collector and you're charged commission, then that commission becomes another income, which then should be taxed. So then the government was arguing that those are the fees that you are earning on loan and on commission, then it should be taxed. Well, let's come to the question you have asked, which I think is a bone of contention. Most people are saying that telephone cost has risen. Okay. Yes, it is true. The telephone cost has risen because of the excess duty, the 20% on the telephone, which was increased on the call rates. Well, the main reason for it is that the government wanted to raise revenue. That is the major reason, just to raise revenue. But on the other side, there have been also excess duties on imports, especially agricultural imports like sugar and eggs. The main reason to why that excess duty is there is to try to make imports expensive and make locally produced sugar and eggs affordable. And this is not just to make them affordable, but to spur local agricultural production, local agricultural produce, so that when you go to the market, you find that sugar imported into Kenya from country A is expensive as sugar manufactured locally. So then you go for the local, because in economics we say that a rational consumer, given the prices and his income, will choose that bundle of good which satisfy him, but also gives him, better pricing, because price is the major determinant of demand. As economists, we say that. Okay, so then we know that the government knows that. The government has that because it knows how a rational consumer behaves. So it simply affects the tax on the imports. That's why the excess duty was increased on those imports. Okay,
Mr. Odera, why should a government that is concerned about its people, and if I can say the Kenyans in this situation, raise some tax to increase revenue? And there are those people who claim after raising the tax for you to get the revenue, it's not translating on the service delivery. Which government should do that to its citizen?
Well, raising of tax is not wrong. The government will only raise tax to meet its expenditure. You know that the government's main source of revenue is tax. Yes. So the government looks at its budget, and part of that budget is basically the taxes, and actually the greater chunk of it is the taxes. Currently our budget is 3.6 trillion, and our taxes finance better part of it. The other part of it is the loan. So you will not normally find that the government will look for avenues for effecting those changes, majorly to generate tax. And it is that tax that the government uses to develop, to pay teachers, to meet recurrent expenditure, and also meet the capital expenditure. The infrastructure, the roads, the railways, the ports, all those are just to be financed from the government, from the taxes that the government is doing. So basically, that's the major reason, just to raise tax, just to raise the revenue. Okay.
Then it's a good call. It's a good call to anyone who is handling the taxpayers' money. Be responsible. We don't want to hear these court cases each and every time about embezzlement or the funds. Be responsible with our taxes, and we'll be there to pay them, and we'll be able to declare all that which we are supposed to be earning and declaring. And this question also comes in from Alex Onsase. The current taxation bill, it's currently an act. It's been passed. And please, Mr. Odera, elaborate in a more common Mwananchi language. How does it affect our Juakali sector or self-employed entities, small businesses? What should we do if the new bill, yes, it's hostile to our businesses? He continues to say so. Yes, Mr. Erick. Before we come back now to finalize the discussion tonight.
Okay. For small businesses, number one is that make sure that you claim all your capital expenditure. Okay. And now at a straight line, so you can claim all that. Number two, make sure that you have all your records kept well and all your source documents ready, and you have all of them, kept well, and your accountant has captured all of them, so that you claim all those expenses that you have incurred in this your small business to reduce your tax. Number three is that if you are a Juakali and you are trading under your name, okay, you'll still be allowed to claim your expenses. Okay, if you're trading, you are trading under your name, claim expenses and also claim your personal relief. Okay, so all that should be able to reduce your taxes. Okay, and if you have a loan, then make sure that you also claim interest expense on it. It will also help you reduce your taxes. Now, if you have done all this and you are still not, you're still feeling that you are not paying you are still paying more, then you can engage a professional like me so that we guide you going forward.
Great, and that's a good answer to bring our discussion almost to an end. But I wouldn't wish to finish without you exploring some of the changes in the key changes, as we put it, and those opportunities within this Finance Act 2021. We still have the retirement benefits, and we have others that you mentioned. If you can just bring us up to speed with some of the key when you talk about retirement benefits. We tackled excess duty, VAT, income tax, and now we are here at capital market also, and at the Retirement Benefit Act.
Just to brush over retirement benefit is that if you are retired and you would want to get all your benefits all at a go, then and those your benefits will exceed 400,000, then they will be taxed at a graduated scale. So then you can only claim your relief, because in that case, then it is not a business and you will not have expenses to incur. However, if you take it maybe on monthly basis and it falls below the threshold, then it will escape tax. So there wasn't much changes on that, and the same case is on the capital markets. The capital markets again.
On this, yes. How do you claim excess tax where you already have a relief? And you outline the process.
Well, Felix, you don't have to claim excess tax. Claim expenses. Okay? Claim all the expenses that you have exclusively incurred to generate your income. It will reduce your tax liability. But if you are an individual and you're trading with maybe Felix your business name is Felix Enterprise. Okay, then Felix Enterprise has its income. Felix Enterprise has its expenses. Then Felix Enterprises, because you are trading under your individual name, can claim personal relief. It will reduce your income, your tax liability.
Great, great. And before you move to capital market, Wellington Ketera, yes, who is watching us from Garissa. Why is it that goods imported are cheaper than those locally manufactured when you still imply to that excise duty tax?
It could be for a number of reasons. Maybe those goods are assembled in Kenya, and therefore maybe they were, for instance, there is a principle called the principle of destination. The principle of destination, even when it applied to vertible products, you'll find that the VAT will only be charged on the final destination of that particular good. So, for instance, if it came from Zimbabwe and it is assembled in Kenya and it is only charged VAT in Kenya, so you might find that it appears like it is imported, but it is only charged in Kenya. It becomes relatively cheaper compared to others. That could be one reason. There could be other reasons, including the fact that it could be a substandard good and all that. Okay.
Great. And so you take us through the capital market, then you can give us the final take on the entire taxation process that we have as a country.
Okay. Now, the government's main initiative when it comes to capital and the Nairobi Stock Exchange is to try and encourage more traders to be able to quote, to have more quoted shares on the capital market, and therefore the tax incentive out of that is to try to bring more traders to be able to quote more shares, and through that the government can generate income. So much of the changes were aimed at attracting more investors into that sector. But the tax rates remains the same. The expenses claimable are still the same. And the incentive is majorly to attract more, and the traders are then able to meet their cost and pay their taxes. I think that was the only. There wasn't any much issue on the capital markets.
And thanks so much, Mr. Erick Odera, for honoring this invite tonight to be here with us as the alternative voice. And we would like, before we bring this to an end, there are those people who've really taken this to be as a tax education to them, and some didn't really understand what taxation really mean. So if you can have your word outside there to those who are not tax compliant citizens, tax compliant employers, and even those people who self-employed themselves, are we in a position to give them some advice, some takeaway? If you can take this moment just to address them and tell them the importance of having this taxation as filing our returns and also being responsible citizens.
Sure. Okay. Our viewers and all the taxpayers outside there, number one is that it is important that you pay your taxes, pay them in good time, and be able to remit them your returns. The main reason for that is that it helps you to access government services. When you are expected to produce a tax compliance certificate, you can produce it by ease. You can get it by ease, and it also helps you to do more. To be able to trade more freely and be able to access, get very good contract and improve your corporate image, and be able to grow. So it is important that you do your taxes correctly, and the best way to do your taxes correctly is to ensure that all your transactions are recorded, and you keep those records very well. You keep them for at least 5 years, and you are able to justify the reason why you declared a particular income, the reason why you claimed a particular expense. If you have any problem with your taxes, then you can engage professionals, and we are here to help guide you, to help take you through, and to grow you. So I would wish to encourage all of us to come out clearly. Don't hide. Just show up and declare your taxes. It is really great. And our country is such a good one where we go through what is called a self-assessment. In other countries where the tax regime is very stiff, you'll find that the government would be handling you and will be sniffing all over, and you'll not be able to escape. But in our case, it is self-assessment. We take you through. We'll help you to claim as much expense as you are that you exclusively incur, and we help as much to reduce your tax burden. And with your tax burden reduced, then you're able to trade, and you're able to grow both as an individual and as a business. Thank you very much on that.
We would like even before we bring this to an end, just a one-word explanation, or if it can be a sentence, just to explain to Joseph Oduor. Andika my name hapo na hiyo kalamu. Sawa, Joseph. Meanwhile, as mkubwa, why the price of petrol in Uganda is more than the price in Kenya? I doubt if that's true. Tax being at the center of it. Which one is higher than the other? I guess Kenya is the current is leading in the region.
I think our taxes are a bit higher compared to the East African countries. Yeah, but the main reason is that the government is trying to generate more income, and it is the fuel is really a good zone for the government. The petroleum products.
Yes.
Yes.
And Beda Uma is here. How do freelancers, how are they expected to handle tax issues, especially if you are getting income outside the country? Is it the digital service tax? What?
If you are a resident, and I believe you are, then you declare it at the end of the year as a resident income, as a resident income tax. Declare it. And if you're a freelancer, then you can claim expenses. You have internet costs, you have telephone costs. If you're working from home and the home is your office, then you can claim rent. Yeah. Then whatever is left as an individual, also you can claim personal relief. Then out of that, you tax the rest at the individual rates. So you'll find that it is something very easy for you to go through.
What a way to bring this discussion to an end. Ladies and gentlemen, thanks so much for sparing your time and your bundles to be here with us tonight. It's been nice having our guest, one talented and highly experienced Mr. Erick Odera. Others call him Odera Kodera. And thanks to everyone who supported us all the way from the point we started till this time. Remember to subscribe, hit that subscribe button, follow us on Facebook, and also be here for more updates and more encouraging stories and more enlightening stories here at The Alternative Voice. It's been nice having you, Mr. Erick Odera, and all our viewers tonight. Have yourselves a good night.